So let's look here inside of chapter 11, and this whole chapter is about taxation. And there are three key taxes that we should know from this chapter. The bulk of our time, frankly, is going to be spent on property taxes, right? Property taxes and how they work and when they're owed and what happens if you don't pay them. That's really where we're going to spend a lot of our time. Then we're also going to move into sales taxes. And then finally, we'll end with a discussion on income taxes. So let's start here on page number 350 with property taxes. Now, the first thing that I would look at is at the middle of page number 350, property taxes are said to be ad valorem. And ad valorem is a Latin term that means according to value. So property taxes are said to be an ad valorem tax here at the middle of page number 350. Now, that term, I know, it sounds like it means add value, but it actually means according to value. We pay property taxes according to the value of our property, but according to what value? In many states, like Georgia, for example, in Georgia, if you say that your house is assessed at $600,000 or $500,000, you know that it's worth about that much. If it's assessed at $500,000, it's probably worth around $500,000. California actually doesn't work that way at all. In California, property taxes are based on something called the assessed value. And the assessed value is kept artificially low based on something called Proposition 13. So I'll give you a quick example of this. Let's say for a moment, you look at the last, it's now 2016, let's look at the last 3 or 4 years. Property values have basically increased in some areas 50, 60% in the last 3 or 4 years. Most people, myself included, would not be able to afford our real estate if the property taxes increased as fast as the property value goes up. In California, the increase in property taxes is capped at 2% per year. So here at the middle of page number 350, first thing I would note, property taxes are said to be ad valorem. What is ad valorem? Ad valorem is a Latin phrase that means according to value. So we pay property taxes according to the value of our property, but according to what value? Your answer, according to the assessed value. Now, if you look here on page number 350, again at the bottom, you'll see Proposition 13. Proposition 13 capped the increase in the assessed value at only 2% per year. So no matter what the value of the home does or building does, if you're the owner and you leave it alone and don't, let's say, add on to it or don't sell it, you won't experience increases in property taxes over 2% per year, and that's Proposition 13. So you could drive down a beautiful street in, let's say, Beverly Hills, where all the houses are worth $7 million, let's say. One guy on one side of the street might be paying property taxes on it like it was worth $7 million, because let's say he just bought it or she just bought it. And another person on the other side of the street might be paying taxes on it like it was only worth $1 million because they bought it so long ago. So again, property taxes are based on the assessed value, which in California has absolutely nothing to do with the market value of the property based on Proposition 13 here at the middle of page number 350. Now, at the bottom of 350 where it says tax rate, you'll see the term 1%. Your property taxes are basically limited to 1% of the assessed value statewide. Now, you might hear that and say, well, that's not true. You know, my tax bill is 1.6% or 1.5% of the assessed value. This 1% is the maximum statewide. The increase over 1% would represent local assessments, right? So 1% is the maximum assessed value tax rate for, statewide. But you might be paying more than 1%, let's say 1.1 or 1.25 or 1.5 or 1.6. Those increases over 1% represent local distinctions in the property tax assessed value. Now, if you look here at the bottom of 350 and the top of 351, we know this term assessed value. Now, in California, the only reason anyone would ever talk about the assessed value, the only reason is in a discussion about property taxes. The assessed value has no relationship to the market value of the property at the bottom of 350 and the top of 351 because it's limited. The increase is limited to 2% per year. The average inflation for real estate, let's say conservatively, at let's say 6% increase. The value of your home is going to go up, let's say 6% a year. Now, some years it's going to go up more, some years it's going to drop, but let's just say it's an average of 6%. Over time, what will happen is that the property taxes will stay about the same because there's just this 2% increase, but the market value is going to go up dramatically. So over time, you'll get a market value way up here, but your property taxes are still way down here. That's, of course, thanks to Proposition 13. No one's complaining about that, right? No property owner in California is going to complain that my house is worth $2 million, but my taxes are based on $400,000. No one's going to complain. Proposition 13 is a huge benefit to property owners, of course, here in California. But frankly, it kind of sucks if you're the state. If you're the state, the state would love to tap you on the shoulder and say, hey, your house went up 25% last year, pay me 25% more in taxes, but they can't do that because of Proposition 13. Now, of course, again, very top at 351, you'll see this top black square. I would underline the number 2%. The maximum increase in our assessed value per year is 2% per year. That's, of course, thanks to Proposition 13. There are, however, two things that could trigger a reassessment. And you might want to write these somewhere, let's say at the top of 351. I would write the words reassessment event. And there are two things that could trigger a reassessment. One thing, I would write the words qualifying sale. So reassessment event, one thing that could trigger a reassessment is a qualifying sale. So if, let's say your house you bought back in the day for $600,000, it's worth $2 million today. Your taxes are still based on $600,000, right? That's the point of Proposition 13, plus these little 2% increases. Now, I show up and I buy your house for $2 million. Now, the property taxes reset to $2 million for me. But then I'm protected under Proposition 13. And in 20 years, when I sell that house for, let's say, $4 million, I'm still paying taxes on it like it was worth $2 million, right? So Prop 13 says when you sell the property to someone else, that will reset the property tax assessed value. Now, certain familial transfers, like maybe a father to a son or a mother to a son, or a transfer between spouses, those transfers would generally be exempt, or they can be exempt from Proposition 13 reassessment. But you and I as two strangers, I buy your house, boom, the property taxes are going to reset. The second thing that I would write at the top of page 351 is I would write the words major addition. A major addition to the property could also trigger a property tax reassessment. Now, how does the government know if you've added on to the property? Well, you're going to pull permits. You pull the permits, there's the red flag, that's going to trigger a property tax reassessment. So two things that could trigger a reassessment of the property tax assessed value. One thing is a qualifying sale. Another thing is a major addition to the property. Now, a couple things that are interesting. If you look at the very bottom of page 351, you'll see two propositions at the bottom of 351. They are Proposition 60 and Proposition 90. These are two other propositions that affect property taxes, and we should know them for the test. We'll start with Prop 60. Now, both 60 and 90, candidly, you do have to be at least 55 to take advantage of these. Let me explain both of these here real quick. Imagine your grandmother. Let's say your grandmother lives here in, let's say, Newport Beach, and she bought her home in Newport Beach in 1980 for, let's say, $175,000. Now, 36 years later now, that home is, let's say, she bought it for, a couple $100,000. It's worth $2 million today, let's say. Now, grandma's still paying property taxes on that house like it was worth what? $200,000, right? Plus these little 2% increases per year. Now, grandma has this big house in Newport Beach. Maybe it's a 3-bedroom, 1,800 square feet. Grandma doesn't need such a big home anymore. She's by herself. Grandma wants to sell that house for $2 million and let's say buy a condo in Newport Beach. Now, what does a condo in Newport cost? A condo, let's say $800,000, right? So she's going to sell this $2 million home and buy a condo for $800K. Now, that $2 million home, grandma's paying taxes on it like it's only worth a couple $100,000 because she bought it so darn long ago. She ends up buying this condo in Newport Beach. What's going to happen to her property taxes? Well, they're going to go up by 4 times, right? She's buying it for $800,000. She's going to have to pay property taxes based on an assessed value of $800,000. Grandma might not be able to afford those increased property taxes. Proposition 60 says if you're at least 55 and you're downsizing within the same county, Proposition 60 lets you take your old property tax basis with you to the next property. It's amazing. So grandma can sell that large home, downsize into a condo, and make her property taxes slide right over to the next condo. Proposition 90 lets you do it from one county to another, same terms, but the county assessor in the next county has to approve your request. And not every county participates in Proposition 90. So again, Prop 60 says if you're at least 55 and you're downsizing within the same county, you can take your old property tax basis with you to the next property. Proposition 60 within the same county. 90 lets you do it from one county to another as long as the county assessor in the next county is okay with it. So again, just a quick review. What proposition says that the maximum increase in the property taxes is no more than 2% per year? That's Proposition 13. What proposition says if you're at least 55 and you're downsizing within the same county, you can take your old basis with you? Prop 60. One county to another, that's of course going to be Proposition 90 here at the bottom of page number 351. Now, two things, again, just as a review, that would trigger a property tax reassessment. One of these, is, of course, is a qualifying sale. Another one is an addition to the property. You add on a new bedroom or put on a new bathroom. That will trigger some portion of the property to be reassessed. Now, one thing I'd look at here at the top of 352, where it says property tax collection. There's a couple of questions that are on the exam but are not in the book, and I want to give you those here right now on page 352. The first is, just something to think about, mathematically, how do you determine the property tax bill annually? Well, your annual property tax bill, and you might want to write this down somewhere at the top of 352, again, on the test but not in the book. The first thing I would write on 352 is I'd write the words annual tax bill equals. So I'm going to give you the formula as to how to calculate your annual tax bill. It's really simple. Your annual tax bill equals, I would write assessed value times tax rate. The assessed value times the tax rate will give you your annual tax bill here at the top of page number 352. So let's say that your house had an assessed value of $400,000, and let's say that the rate in your area was 1.25%. So it's assessed at $400,000, the rate's 1.25%. You're just going to multiply those two numbers. You're going to take $400,000 times 1.25%. That's going to give us $5,000. So your annual tax bill is going to be $5,000. How do we get that? We took the assessed value times the tax rate in your area. So I'd write a couple things here. We have our formula as to how to calculate our annual taxes, right? We take the assessed value and we multiply it by the tax rate. But there's a couple of follow-up questions that you might find on the test. And to calculate our annual tax bill, again, we're going to take the assessed value and we're going to multiply it by the tax rate in your area. Now, underneath assessed value, I would write the words determined by county assessor. The county assessor is the elected official that determines your assessed value. The property tax rate in your area is determined by the County Board of Supervisors. So right next to tax rate, I hope you wrote County Board of Supervisors. Next to assessed value, I hope you wrote the words county assessor. So again, just a quick review. How do we determine our annual tax bill? We take the assessed value times the rate. Underneath tax rate, I hope you wrote the words County Board of Supervisors. Next to assessed value, of course, that's determined by the county assessor. Now, knowing what you know about reassessment events, right? You know that when you sell the property, it's going to trigger a reassessment. You already know that. Do you think that the county assessor would want to know if you sold your property? Of course, the county assessor would want to know if you sold your property. You have to tell the assessor within 45 days. And I'd look here at the top of 352, underneath property tax collection. The county assessor is the elected official responsible for determining your assessed value, right? The county assessor determines your assessed value. Do you think that the county assessor would want to know if you sold your property? Of course. This is going to trigger a property tax reassessment in most cases. How many days do you have to tell the county assessor that you sold it? 45 days of the transfer. Now, famously here a few years ago, you might have read this in the news, the LA county assessor was put in jail. Now, of course, the elected official, the county assessor is an elected official. At the end of the day, this person's simply a politician. He allegedly told his friends and contributors, hey, help me get in position. Once I'm in position, your house that you just bought in Bel Air and Brentwood and Holmby Hills and wherever else you live, I'll just say that it's worth less, right? It'll save you money on your tax bill. Of course, a junior assessor blew the whistle on the county assessor of Los Angeles, and the LA county assessor was put in jail for these alleged crimes. So the county assessor is the elected official responsible for determining your assessed value. Do you think the county assessor would want to know if you sold your property? Of course he would. a change of ownership statement must be filed with the county assessor within 45 days of the transfer, here, of course, on page 352. But let me ask you this. What happens if you bought a home? Let's say you bought a house in the height of the recession. I was just with a good friend of mine and a former student, Muhammad Alam. You can look him up online. But Muhammad is the number one, probably, for sure the top 10, but maybe depending on what month you check, he might be the number one real estate agent in all of the high desert, Victorville, Apple Valley, Hesperia. Muhammad will sell about 3 to 4 properties a week, right? Muhammad will do like 150 transactions a year. Now, what I admire most about Muhammad, again, he took our class many years ago, but what I admire most about him is his resilience. You know, he was selling houses in Victorville for $420,000 in 2006 at the top of the market. By 2009, those same homes were, this is not an exaggeration, were worth like $95,000. So he showed remarkable resilience through a recession that basically saw every one of his commissions cut by 75 to 80%. But the point is, imagine you bought a house in Victorville at the height of the market at the summer of 2006, and you bought it for $400,000. 3 years later, the guy next to you buys a better house than yours for a quarter of the price. You're pissed, right? The value of your house went down. But you're probably also upset that your property taxes are high. You bought it for $420,000, and the houses are selling for $100,000. Can you appeal? Yes, you can appeal. If you look at page 352, right below this gray box that says taxpayer rights, I would just highlight or put a star by that sentence that says, a taxpayer who disagrees with the assessor's opinion of value may appeal that decision by filing an appeal with the Assessment Appeals Division inside of the assessor's office. Now, how busy do you think these guys were at the Appeals Division 2008, 2009, 2010, 11, as the market slid, 10, 15% a year or more? Oh, these guys were swamped, right? Now, 2016, what's happened to the market? Over the last 3 years, it's gone up. Am I going to complain that the house I bought in 2009 for $300,000 is worth more? No, because my property taxes are still really low. So the appeals division isn't so busy today because property values have risen and property taxes have stayed low because of Prop 13. When the market does the opposite, when the market slides, right? You bought your house for $650, now they're selling for $400. Yeah, you're going to appeal that property tax assessed value because you're paying more in taxes than the market value of the property. Now, one thing I'd look at here, if you look at 354, check out on 354 where it says how to compute the basic tax rate at the middle of 354. I got a little mnemonic device that'll help you remember the due dates and the delinquent dates for property tax payments. And in fact, at the middle of 354, right underneath how to compute the basic tax rate, I would write the sentence, no darn foolin' around. If you remember no darn foolin' around, NDFA, you will never forget the due dates and the delinquent dates for property tax payments. So again, no darn fooling around in a vertical line. And next to the N in no, I would write the words November 1st. Next to the D in darn, I would write December 10th. That's the first installment of property taxes. Property taxes are due on November 1st, delinquent after December the 10th. That's the first installment. The F in foolin', I'd write February 1st, and next to the A in around, I'd write April 10th. The second installment is due on February 1st and delinquent after April the 10th. So again, no darn fooling around, November 1st, December 10th, February 1st, and April 10th. So these are quick, easy questions we can get right on the exam. The first installment of county real property taxes is due when? November 1st. Delinquent after December the 10th. The second installment is due on February 1st and delinquent after April the 10th, right? No darn fooling around. Now, looking at these due dates and the delinquent dates, you might say to yourself, well, how is it possible that November is the first installment and February is the second? February comes before November in the calendar year. Shouldn't February be the first installment and November the second installment? Well, the tax year actually doesn't go from January to December like the calendar year. The tax year actually goes from July 1st through June 30th. And you'll see this, of course, here on page 355. Notice this tax calendar. It goes from July 1st through June 30th. So if the tax year starts in July, we have July, August, September, October, November, the first installment's due. December, it's late. January of the next calendar year, then February, the second installment's due, and April, it's late. So again, quick, easy questions we can get right on the exam. The first installment of county real property taxes is due when? November 1st. Delinquent after December the 10th. The second installment is due on February 1st and delinquent after April 10th. And the reason those dates are the way they are, of course, is because of the tax calendar. The calendar year does not go from January to December. The tax calendar year goes from July 1st through June 30th, and you'll see this, of course, on the chart at the top of page number 355. But here's a question you might have thought, because, frankly, there are a lot of television infomercials and books that people sell about buying real estate by just paying the back taxes. Maybe you've seen these infomercials or ads online where, hey, buy this book for $50 and we'll tell you how to buy homes by just paying the back taxes. Now first, is that true that you could buy a home or a building and just pay the back taxes? Yeah, it's true. Theoretically, you could. But how come you and I probably don't know someone who bought a house in, the Hollywood Hills or in Newport Beach or in, Saratoga, very expensive areas, by just paying the back property taxes? Well, a couple things. First, if you look here on page number 356 and 357, we'll start at the top at 357, tax sale. The government gives you 5 years, as it says at the top of 357, the government gives you 5 years to redeem your property. There is a 5-year redemption period on non-payment of property taxes, which means before the state can force the sale of your home, you have to have missed your property tax payments consecutively 5 years in a row, right? So most people, or a lot of people, will fix that before that 5-year period. The other thing that makes this more of a challenge, quite frankly, and this is actually the real reason why, is most people that have a house have a loan on it too. If I have a loan on my home with Wells Fargo and I don't pay my taxes for a couple of years, do you think Wells Fargo is going to be okay with me not paying my property taxes? Of course not. Wells Fargo is not going to be okay with that. Wells Fargo, in fact, can call my loan due before this 5-year period even hits. That's, of course, called an acceleration clause. You might remember that if you've taken Chapter 8 or you've heard the lecture for Chapter 8 already. A bank is not going to wait 5 years for the state to take that home. The bank will either foreclose on me first, they'll cure those taxes, but they're going to protect their position. So a lot of people that buy properties at tax sales, really the properties that are generally sold at tax sales are like raw land, right? If somebody buys a piece of raw land, forgets they have it, and after some number of years, it's sold at a tax sale. But theoretically, yes, if I didn't pay my taxes for 5 years, you could come to a tax sale auction or bid online, some of these are done on the internet, and buy my home for just paying the back taxes. Now, how long do I have to cure non-payment of property taxes? I have a 5-year redemption period for non-payment of taxes here on page 357. Another thing, if you look at the middle of 357, if you do buy my property at a tax sale, you're going to get something called a tax deed here at the middle of 357. A tax deed is issued to the high bidder at a tax sale here on page number 357. So a couple questions happening here for the test. Number one, the redemption period for non-payment of property taxes is 5 years. Most likely, though, in practice, that 5-year period isn't going to come because the lender will invoke an acceleration provision before that anyway, most likely. But if you did buy my property at a tax sale, you would be issued a document here at the middle of 357 called a tax deed. Now, if you come back to 356, you'll see the term tax lien. Tax liens are placed on properties on January 1st. Very commonly asked question on the exam. The lien date for non-payment of property taxes is when? Your answer, January 1st, here on page number 356. Now, another thing I'd look at here, if you look at 358 and 359, the next pages, I just want to take a quick second to talk about special assessments for the test. Now, 358 and 359 kind of go together. We'll start here on page 359 with Mello Roos. Mello Roos is a special assessment. And I'll give you an example of a way to think about this. Let's say the street you live on, let's say you live on, I don't know, Sugar Gum, right? Or Snapdragon, or whatever street you live on. Who named your street? Well, the person that named your street, of course, is the developer that built it. Because if a developer builds 10, 20, 30, 50, 100 houses somewhere, she doesn't just have the cost of building the homes. She has to pay for streets, sidewalks, curbs, gutters, light, sewer, all the infrastructure in the area. There is a law called the Mello Roos Community Facilities Act here on 359 in the gray box. Here's what the Mello Roos Community Facilities Act basically says. Mello Roos lets a developer go to investors and borrow money from those investors to fund the infrastructure in the area. So they could borrow money from a group of investors, use that money to build out the streets, sidewalks, curbs, gutters, lights, and sewers. Then the developer will make all those homeowners in that area pay for the cost of that infrastructure through a Mello Roos bond. This might last, let's say, 20 years. So a couple key things here. Number one, whose responsibility is it to create infrastructure in an area? A, the city, B, the county, C, the state, D, the developer. Your answer, the developer. Number two, a developer can offload the cost of that infrastructure onto residents by floating a Mello Roos bond here on page 359. And this is paid in addition to your property taxes. So let me ask you this. Do you probably have Mello Roos in, let's say, Santa Monica? No, you probably don't have Mello Roos in most of Santa Monica. Why? Because it's just old, right? You don't have Mello Roos in much of Beverly Hills because it's just old, right? All the infrastructure has been constructed already. Where would you have Mello Roos? You'd have it in newer communities: Corona, Eastvale, Rancho Cucamonga, Chino Hills, Irvine, Mission Viejo, Coto de Cas. All these newer areas are going to have Mello Roos for the most part because the infrastructure was recently built. Now, either way, if you were buying a home, would you probably want to know that you're going to have to pay Mello Roos on top of your property taxes for this special assessment? Of course. That's why if you look at the top of 359, you'll see this gray box. And then look at the second paragraph in that gray box. It says, because of the confusion over the nature of Mello Roos and the fact that these don't always appear on the tax bill, a seller of a 1 to 4 unit family dwelling subject to Mello Roos must disclose that fact to a prospective purchaser. What that means is if you buy my house, let's say in Chino Hills, a newer area, and it has Mello Roos, do I have to tell you as the buyer that the property has a Mello Roos? I do, right? The seller must disclose this. Now, of course, if there's a real estate agent involved, it's the listing agent or the seller's agent's side that's responsible for disclosing the existence of Mello Roos to a buyer. Now, you could invest as a private citizen. You could invest in Mello Roos bonds. In fact, a company that sells a lot of these bonds is a company called Wedbush. You can go to their website, wedbush.com, and you could invest in Mello Roos bonds. You're probably not going to find Mello Roos bonds again in Beverly Hills or in Santa Monica because it's just old, right? You will find them in San Jacinto, Mission Viejo, again, Aliso Viejo, Ladera Ranch. These newer areas often will have anyway, Mello Roos assessments. Now, here at the bottom of page 359, you'll see this term documentary transfer tax. Documentary transfer tax is a tax that is paid to the county every time you transact real estate within the county. If you sell a home, let's say in LA County, you'll have to pay LA County what's called a documentary transfer tax. Now, this is just a tax for nothing. Like literally, the county just says, okay, you sold a house in my county, pay us. The rate for this, as it says on page 359, the rate for this is 55 cents per 500, or fraction thereof. So documentary transfer tax is a tax that's paid to the county. It's 55 cents per 500, or fraction thereof. So I'll give you a quick example of this, right? So a couple things that you might want to write here at the bottom of 359 next to documentary transfer tax. The first thing, again, is the rate. The rate is 55 cents per 500, or fraction thereof. And you might want to write that at the bottom of 359. Next to number 2, I would write the words only charged on new money. Documentary transfer tax is only charged on new money. Now, again, that might not make sense now. It will in a second, I promise. But we got 2 things to form our foundation of this transfer tax. First, the rate is 55 cents per 500, or fraction, and it's only charged on new money. So I'll give you an example. Let's say that you bought a house for $500. I know there are no houses for $500, just humor me. You bought a house for $500. How much is paid in transfer tax? Okay, 55 cents, right? $500, 55 cents on the transfer tax. Let's say that you bought a house for $1,000. Now how much would you pay in the transfer tax? You'd pay $1.10, right? 2 units of 500, you're going to pay $1.10. How about this? Let's say that you bought a house for $1,001. Now you'd pay $1.65, right? You'd pay an additional 55 cents in the transfer tax. That next dollar increased it by 55 cents. So again, it's 55 cents per 500 or fraction thereof. Now, you also wrote only charged on new money. Well, what does that mean? I'll give you an example of this. Let's say for a moment that you bought a property for $1,000. Of that $1,000, $500 you paid cash. The other $500 you assumed a loan. So what does that mean when you assume a loan? You take over my old loan. Now, when you take over my loan, is that new money or old money? That's old money, right? That loan was already there. So that $1,000 deal, $500 assumed loan, $500 you paid cash, that deal only has $500 in new money. So that $1,000 deal would only have 55 cents in the transfer tax. So again, what is documentary transfer tax? It's a tax charged by the county. How is it calculated? It's 55 cents per 500 or fraction thereof, and it's only charged on new money. Now, let me show you how this might appear if you get this question on your exam. Here at the bottom of page 359, it says, this example, it says, the 1200 Via Loca house is sold for $687,575. An existing first is assumed for $524,000. Now again, when you assume a loan, is that new money or old money? That's old money, right? So we don't pay the transfer tax on the old money. So I'm going to take that out of the transaction. So $687,575 minus $524,000. This is going to give us, because remember, we took that loan out. It's assumed it's old money. It's not relevant for transfer tax. So I take $687,575 and I subtract $524,000. That gives me $163,575 in the new money at the bottom of 359. Now, I want to know how many units of 500 are in $163,575. So I'm going to divide $163,575 by 500. That'll give me how many units of 500 are in this. I divide those, it gives me 327.15. Now again, it's or fraction thereof. So that 327.15 is going to become 328. We got to round it up. Hell, that could have been 327.01, and we'd have to round it up to 328. Then from that 328, we're going to apply our rate. Our rate's 55 cents per 500. We have 328 units of 500. We multiply that by 55 cents. This gives us $180.40 here at the bottom of 359. Now, by the way, just so you know how this works transactionally, this is generally a tax that's paid by the seller. Typically, the seller is going to absorb these transfer taxes, but that's not a law. It's negotiated in the contract, but our industry standard is that this would be a fee that the seller would pay to the county. Now, some cities got hip to this and they said, hey, well, if the county can get away with getting some revenue from these transfer taxes, maybe the city should do it too. And there's a list here on page 360 of the cities, some cities anyway, not all. You'll want to check with your local escrow company or your broker or manager to find out what if your city charges an additional city transfer tax. But there's a list here on page 360. These are the rates per thousand. So for example, Culver City charges $4.50 per thousand on top of the $1.10 per thousand or 55 cents per 500 that the County of Los Angeles charges. So these are important costs that your seller will pay, and it's important to advise your seller of their responsibility of paying these transfer taxes if in fact the contract is going to call for them to pay it. And this is of course on 359 and 360. So we left off here of course on page number 361 and this discussion about sales tax. Now, you know, if you go buy a tie or you go buy some shoes or you buy a car, you're going to have to pay sales tax, right? Now, is the sale of real estate something that is subject to a sales tax? That's the question, right? So this is in a real estate book. There's a discussion about sales taxes. Your question naturally might be, well, do you pay sales tax like when you go buy a car on a home? Of course not. You don't pay sales tax when you buy a home or when you buy a building. Thank God. That would crush our industry if we had to pay a sales tax on the sale of or the purchase of a home. But you might ask yourself, well, if I'm saying that there isn't a sales tax when you buy a home, why is there a whole page on page 361 devoted to sales taxes if real estate is not subject to a sales tax? Well, the reason, candidly, is because some of our students and some real estate professionals don't actually want to sell real estate. They want to sell businesses like, liquor stores or dry cleaners or car washes or coin laundromats or restaurants. So think about this. Does a restaurant charge tax? Yeah, a restaurant charges tax. So if you look here on page number 361, if you want to sell a restaurant for someone else, you'll need a real estate license to do that. We spoke about that, of course, in chapter 1. So real estate agents could sell businesses like restaurants. So let me give you an example. Let's say that you went to a restaurant, any restaurant, take your pick, and you and your friend had dinner. Maybe the dinner for two cost $40. I'm picking something up. So you'll pay the $40 bill, you'll tip, and you'll also pay sales tax. That sales tax, 8 3/4, 9 1/4, depending on where you are, you'll pay that. Now, initially, that 9 1/4% or whatever the tax rate is in your area, initially, that, let's say $3.50 is paid to the restaurant. The restaurant will then take that money and send it to the State Board of Equalization. Now, big restaurants like the Cheesecake Factory or the Olive Garden or BJ's or Red Lobster, any of those large restaurants, they're going to have a system in place to make sure that they are properly reporting and sending all their sales taxes that they collect to the State Board of Equalization. So that's a note that you might want to write here somewhere on page number 361. You'll see it at the top of the page too, right near where it says other state taxes, sales tax and use tax. The entity in California that collects and administers sales tax is called the State Board of Equalization. Now, again, larger restaurants, like the ones I mentioned before, are going to have a system in place to make sure that appropriate sales taxes are being paid. But can you imagine some mom and pop restaurants, you pay $4 or $5 in tax, they look to the left, look to the right, put that money in their pocket and don't send it to the State Board of Equalization. That happens sometimes. And in fact, it's important to know that if you buy my restaurant, let's say I got a little sushi place or a little taco stand somewhere, and I have, let's say, $6,000 in back sales tax that I should have sent to the State Board of Equalization, but I didn't. I stole it, basically. I collected it from the customer, but did not remit it to the State Board of Equalization to the tune of like $6,000. If you buy my business, you, as the buyer of my business, are liable for that back sales tax. That is a legal theory called successor's liability. And you may want to write that down somewhere on page number 361 on the test, but not in the book. You may want to put that on 361, this concept of successor's liability. Successor's liability says the buyer of a business is liable for the seller's back sales tax. So again, the buyer of a business is liable for the seller's back sales tax. That's called successor's liability. Now, wouldn't you want to know, if you bought a business, wouldn't you want to have some assurance that the seller had no back sales tax? Of course, you would contact the State Board of Equalization. The State Board of Equalization would then give you something called a clearance receipt. So if you look here at the bottom of 361, right near where it's above where it says broker sales of manufactured homes, you'll see the term tax clearance in italics at the bottom of 361. That's okay too, but the state exam might call this a clearance receipt. So you may want to put that term at the bottom of 361, clearance receipt. Who do you get that from? You get it from the Board of Equalization, and that document shows that there is no successor's liability. So again, 3 questions for the test. Number 1, about sales tax. Number 1, the legal theory that says the buyer of a business is liable for the seller's back tax, successor's liability. Who would you contact to make sure everything is okay? State Board of Equalization. If everything is okay, they're going to give you something called a clearance receipt. So look at all we've talked about so far. We've talked about property taxes. You know about Proposition 13, Proposition 60, Proposition 90. You know about the property tax calendar, right? No darn fooling around. Talked about the tax sale and Mello Roos. Talked about documentary transfer tax. And now, of course, we talked about sales taxes. I want to end this chapter with page number 363, this concept of federal income taxes. Now, income taxes, one word you might want to write on page 363, right next to federal income taxes, I would write the word progressive. Federal income taxes are said to be progressive in nature, meaning the more you make, the more you pay. That's a progressive tax system. Now, I think we all know sometimes the more you make, the less you pay. But theoretically, our system is supposed to be set up as one that is progressive, meaning the more you make, the more you pay. Now, there are two types of income that we should know for the exam. And you'll see these on page 364. They are ordinary income, and then at the top of 365, capital gains income. So there's ordinary income on 364, and then there's capital gains income on 365. Ordinary income, and again, you'll see this at the bottom half of 364. Ordinary income are your wages, your tips, your salaries, your commissions. Wages, tips, salaries, and commissions are, of course, known as ordinary income. Capital gains income, on the other hand, at the top of 365, this is money that you would make from the sale of a capital asset. So what's a capital asset? Back, of course, on 364 at the bottom, a capital asset could be, for example, stocks, could be bonds, could be real estate. So you bought a building for $400,000. Several years go by, you sell it for $600,000. You have a $200,000 capital gain. So again, a capital gain is money that is made from the sale of a capital asset. What's a capital asset? Again, stocks, bonds, real estate, they're all capital assets. Now, if you look here on 365, capital gains are going to vary in terms of how these are taxed to you. These are going to vary when you talk about your primary residence and also when you talk about property held for investment or income. So property held for investment or income are going to have different tax rules than, let's say, property that is your primary residence. I'll give you an example of how to look at this. Maybe you have a gardener. If you have a home, maybe you have a gardener that comes to your house to mow your lawn every week. Now, that gardener, I don't know what you pay a gardener. Let's say it's $70 a month or $100 a month or whatever a gardener charges. Are you writing off that gardener that comes to your house that you live in on your taxes? Well, if you are, you should not repeat that in public to anyone ever, because your gardener that comes to mow your lawn to your house is not generally considered a tax deduction. Now, if let's say you own a building, you own a hotel, you own an office building, or you own an investment home, you have someone mow the lawn at your office building that you own, that's of course a write-off generally to the income on the building. So you can see that different rules are going to apply to property held for investment versus property that is your primary residence. Maybe you have a cleaning person that comes to your home to, clean your house once every how often? Are you going to write off that cleaning person that comes to your house? Again, if you are doing that, you should keep that to yourself, because the cleaning person that comes to clean your house every week or month or whatever is definitely not a tax deduction for you generally. Now, if you own this building that we're in here and you have a janitorial service that comes to, clean this building, of course, that's generally a write-off on the income of the building. So again, different rules for your primary residence versus property held for investment or income. Now, here at the middle of 365, let's talk about tax considerations for the homeowner here at the middle of 365. So everyone says, for example, death and taxes, right? Those are the two things that are basically guaranteed. Now, I guess there's not really a way around death, but there is a way around taxes. There is a way, legally, that you could tell the IRS that you made some money, and they just say, you know what, just keep it. It's yours. Don't worry about it. Just have a good day. That generally applies on the sale of your primary residence. And if you look here on page 365, I'll go over the rule with you. It's actually quite simple. If you want to apply this rule where you can sell a home that you live in, your primary residence, and not pay the tax on page number 365, here's how this would work. First question, are you single or married? Hopefully that's an easy question for you to answer. Are you single or married? If you're single, the number is $250,000. If you are married, the number is $500,000. But you have to have lived in the property for 2 years out of the last 5 years. So a lot of people are confused by that. Well, what does that mean? 2 out of the last 5 years. Well, let's say today is 2000, and let's say it's 2016 currently. Go back 5 years to 2011. During those 5 years, have you lived in it for 2 years out of the last 5 years? If you can say yes to that, now it doesn't have to necessarily be the most recent 2, but it's got to be 2 out of the last 5 years. If you've lived in it according to that schedule and you're single, the first $250,000 in gain, tax-free. Don't pay tax now, don't pay tax ever, it's tax-free. If you're married, it gets even better. If you're married, the first $500,000 in gain, tax-free. So let's say I'm single, I bought my house, let's say in 2010. I've lived in it from 2010 till now. Consistently for the last 6 years, I've lived in the home. Now I can apply this rule, right? I'm single. If I bought my home, the first $250,000 in gain, tax-free. So again, I bought my house for $400,000, let's say. I'm going to sell it for $650,000. I'm going to make $250,000. That $250,000, I don't pay a nickel of tax on that. Don't pay tax now, don't pay tax ever. If I was married at the time of sale, I could get $500,000. So I bought my house for $400,000, lived in it for 5 years, and I sell it for $900,000. Bought it for $400,000, sold it for $900,000. I made $500,000. I don't pay a dime in tax on that money because I've lived in it for 2 out of the last 5 years. Now again, how often could you redo this? You could redo this every 2 years, right? You don't have to live in it 5 years. You just have to have lived in it 2 years out of the last 5 years. Now, there's a lot of different rules that can apply to this. For example, that time period might be stretched under IRS rules if, let's say, I was in the Marine Corps and I was deployed to, let's say, the Middle East or to Asia or to, Latin America or whatever. I was out of the country for a while. There's different rules as to how that time period is calculated. So you're going to want to check with your CPA to make sure that you're applying this rule appropriately. If you want to research more on this, this is section 121 of the Internal Revenue Code that makes this possible. So again, very simple though. First question, single or married? If you're single, $250,000, married, $500,000. And again, this is the gain amount. This is not $500,000 in the sales price. This is $500,000 in the gain. So I bought the house for $400,000, I sold it for $900,000. I have a $500,000 gain. Now, the truth is, you have to take into account costs of acquisition. So when I bought the house for $400,000, I probably paid escrow fees and title fees and loan points and all this sort of thing. And when I sell the house for $900,000, I'm going to have costs to sell it. I'm going to have a real estate commission and closing costs and maybe buyer concession. So that gain's going to get even more narrow in my story. But again, very simple. Single $250,000, married $500,000. Have you lived in the home for 2 years out of the last 5? Now, somebody might call the office and say, hey, I bought my house in 2002. I lived in it from 2002 till 2009. It's been a rental from 2009 till now. Can I apply this rule? No. You've been out of it too long. You've been out of it since 2009. If you want to do this rule, what do you got to do? You got to pack up your stuff, move into it, sit there for 2 years, and then you can apply this rule potentially under section 121. And as a homeowner, it gets even better. If you look here on page 366, where it says deductions, couple things that are critical at the top of 366. The first thing at the top of 366 that's important is, when you own a home, every dime in property taxes you pay at the top of 366 is a tax deduction. When you pay mortgage interest, every dime in interest that you pay on loan amounts of up to $1 million is considered a tax deduction. So again, real estate owners are almost considered like this protected class, right? And as it relates to the tax code, where you can make money and not pay the tax, and you have all these write-offs that you can take when you own a home here on page number 366. Now, these are for homeowners, right? These are for people that own a home and occupy it as their primary residence. If you own investment real estate, there's something that you can do here on page 367 that I want to share with you, and it's a concept called depreciation. So here's basically how depreciation works on page 367. You and I both know, as taxpayers, our goal is to make our income lower on our tax return. Legally, of course, right? We're not breaking any laws, but we're trying to get as much of a deduction as we can each and every year on our taxes so our adjusted income is lower, which means we pay less in tax. One way that an owner of investment real estate could take a write-off is this concept of depreciation here on page 367. Here's how depreciation works. Somebody a long time ago told the IRS, hey, I own that property over there and it's an investment. The IRS is like, okay, so what? Well, because it's an investment and it's outside, right? The building sits outside. Every day that the sun beats on it, the sun kind of deteriorates the building a little bit. When it rains, the rain pelts the building a little bit. So I figure, the taxpayer said, I should be able to write off some of my income attributable to that wear and tear on the property. Miraculously, the IRS bought it, and they said, okay, fine, you can depreciate your building, but we won't let you depreciate two things. The first thing that you cannot apply depreciation on is you can't depreciate raw land. So raw land is not something that could be depreciated because there's no wear and tear, right? This is a compensation for wear and tear on a property. There isn't any wear and tear on raw land. I mean, if you own 3 acres of land in Barstow and you took a stick of dynamite and blew a hole in the middle of it, it's not really worth any less with that small crater in it than it would have been worth, if it didn't have the hole in it, right? So there is no depreciation on raw land. So if you depreciate this big building we're in now, we could depreciate the building, but we would have to extract the land from that and just apply depreciation to the building. The second thing that we can't depreciate is we can't depreciate anything owner-occupied. So you couldn't depreciate your primary residence because we have other rules that are tax shelters for the primary residence, but you couldn't apply this concept of depreciation to your primary residence. So the two things that are not depreciable, one, raw land. Number two is, of course, your primary residence. So let me give you an example of how you might see this on the exam here at the middle of page 367 for an investment property. It says, Richard Rembrandt purchased an apartment building for $7.5 million. The land is valued at $800,000. Immediately, because this is a depreciation calculation, what do we know is going to happen to that $800,000? We have to take it out, right? That's $7.5 million, land and a building. We have to subtract out the value of the land because the land is not depreciable. This leaves us with $6.7 million for just the building. That is the amount that we could depreciate. Now, generally accepted accounting principles that are imposed on us by the IRS say residential investment property could be depreciated over 27 and a half years. So the salvage life of an investment residential piece of property is 27 and a half years. So on paper, on the books, we're going to pretend that over 27 and a half years, the value of the building every year drops. And then at the end of 27 and a half years, the building is worthless. Now, you and I both know if you bought a piece of investment real estate today, after 27 and a half years, it might be worth 5 times what you paid for it. But on paper, we're going to make believe that the value of the property is dropping every year. And eventually, at the end of 27 and a half years, it's zero. So the question is, what is the amount of yearly depreciation available to Richard? Now, we know we can't depreciate the land. So the $6.7 million is the amount that is depreciable. The book here says that we have a 27 and a half year life. So I'm going to take the $6.7 million, divide it by 27 and a half years, and this is going to give us $243,636 per year. That means that every year, the income on the building is going to go down by $243,000 just for tax purposes. Again, this isn't something that's actually happening. Depreciation is just a tax shelter for the real estate investor to drop their income to pay ultimately less tax, right? So could we depreciate investment real estate? Of course. The only things we can't depreciate are raw land and anything owner-occupied. We know that real estate is depreciated middle of page 367, under the middle of 367, yes, under the straight line method of depreciation, which means every year we're taking an equal amount of depreciation, equally over a 27 and a half year period. The yearly depreciation deduction here, of course, is $243,000 and change. How did I get that? I took the building and the land, subtracted out the land, because that's not depreciable, and then divided the value of the building by its salvage life, which is 27 and a half years. Could you do that to your house that you live in? Not generally, because, again, owner-occupied property is not depreciable. You can't do this, nor can you do this on raw land. So this is just for real estate investors. Another thing that is also unique to real estate investors is on page 368 and 369. It's called the tax-deferred exchange. You might have heard of this before, a 1031 exchange. Perhaps you've heard of that. The 1031 is the section of the Internal Revenue Code that makes this exchange possible. So let me give you a quick example here. Let's say that you bought a building here in Los Angeles for, maybe you bought it 20 years ago for $700,000. Building's worth $5 million now. You have a problem now. It's a good problem, but it's still a problem. You have a pretty significant, pretty hefty income tax bill because you made so much money. Again, that's a good problem, but it's still a problem. Here's what you could do under these 1031 rules. You could sell that building and then within 6 months buy another building and defer the income taxes. Now, this is also sometimes called a 1031 like-kind exchange, which means the exchange must be between like-for-like property. Now, when I say like for like, all I mean is real property for other real property. Now, if you sold an office building here in Los Angeles, you don't have to buy another office building. You just have to buy other investment real estate. You could buy some raw land. You could buy some apartment units. You could buy a warehouse. You could buy a single-family rental property. You could buy another office building, but you're not required to. So it's a 1031 like-kind exchange. But when I say like-kind, again, I don't mean industrial building for other industrial building. I just mean real property for other real property. And if you look here at the bottom of 368, you'll see the term delayed exchanges at the bottom of 368. A delayed exchange, of course, just means you're selling one investment property. Then within 45 days, you have to nominate other properties that you might want to buy. And then you have a maximum of 135 days to close escrow on one or more of those properties. So all I'm doing is selling one investment property, choosing other ones that I might want to buy within the next 45 days, and then I have a maximum of 135 days to complete the 180 to close. Now, it's hard to overstate how big of a deal this is. Imagine, the stock market over the last few years has gone bananas, right? It's gone up a lot. Could I tell the IRS, I bought some, make something up. I bought some Tesla stock, the electric car company. I bought some Tesla stock. I bought $100,000 worth. Now it's worth $300,000. I want to sell it and not pay any income tax on that, but I promise I'll buy, let's say, some Disney stock with it. The IRS is going to say, I don't care what you do with that money, you got to pay tax. Whether you buy some more stock, you go to Vegas and gamble, you go to Miami on vacation, do whatever the hell you want. But that money you made on that Tesla stock, you owe us. In real estate, again, it's like the real estate investor is some kind of protected class. The real estate investor can sell an investment property, buy another investment property, or spread the money around, right? There's rules for nomination, but you're basically taking money from one investment property and moving it into the purchase of other investment property and paying how much tax? Paying no tax. Now, let me explain a couple differences between the 1031 that we just spoke about and the 121, which is the sale of your primary residence. Now, when you sell your primary residence, remember, single 250, married 500, have to have lived in it for 2 out of the last 5 years. Am I saying that you need to take that money and buy another property with it? No. You can go back and live with your mother for the rest of your life, and you'll never pay a dime in tax on that. With the 1031, it's called an exchange, meaning that you are going to have to, within the specified time, buy other investment real estate, number one. Number two, the 1031 with investment property is a tax-deferred sale, meaning, I don't owe the money now, but I may owe the money down the road if and when I cash out. With a 121 sale, when you're selling your primary residence, this is not a deferral. This is a tax-free sale. You don't pay tax now. You don't pay tax ever. That is the key difference between the 121 and the 1031. Well, a couple of key differences, right? One, on the 1031, it's an exchange, not a tax-free sale. Number two, with the 1031, you are deferring the taxes. You're saying, I don't owe it now, but I might owe it later if I cash out. On a 121, it's not that way. And again, 1031 is for investment property. 121 is for your primary residence. So a lot of stuff in this chapter, right? We talked about property taxes and Prop 13 and Prop 60 and Prop 90. We talked, of course, about the tax calendar. We talked about sales taxes and special assessments like Mello Roos. We talked about income taxes. I'd encourage you to do the quiz again for this chapter online and in the book, and let us know if you have any questions.